Tuesday, April 13th, 2023, Maneco 64, home of alternative economics and contrarian views. We're going to look at the Fed's discount window today, and it doesn't look good. It's pointing to a crisis of massive proportions, I would say. The last time we've seen activity like this at the discount window wasn't good. And that's what we're going to focus on today. Before I start, though, I'd like to give a shout out to ITM Trading. So if you're looking for ways to protect your wealth during these uncertain times, learn how to develop a customized strategy to safeguard your assets with ITM Trading's expert gold and silver analyst team. Yes, as Lynette Zhang says, you could also thrive during crisis, not just protect your wealth. So if you want to learn more about ITM Trading, go to the description of this video and click on the link there. So, discount window. What is the discount window? Well, it's basically when commercial banks can't borrow anymore from other financial institutions. They go to the Fed discount window. It's the last resort. It's taboo. You don't want to be seen, or you don't want people, other institutions, or the street, as they call it, to know that your institution has had to borrow from the Fed. It could mean the end of your bank. And this is what Investopedia says. What is a discount window? Why and how do banks use it? Discount window is a central bank lending facility meant to help commercial banks manage short-term liquidity needs. Banks that are unable to borrow from other banks in the Fed funds market may borrow directly from the central bank's discount window, paying the federal discount rate. So yes, as I said, it's not something banks use very often, and you'll see here from this article in Bloomberg, and this was about a month ago, this article, and you might say, well, it's old news, but my point here is to show you what could happen and when the last time this happened. So this is what it says. Banks borrow 164.8 billion from Fed in rush to backstop liquidity. Discount window borrowing surged to record 152.85 billion. New facility usage totaled 11.9 billion in first 3 days. So I won't go through the article. I'll put a link to it below in the description. But what I wanted to show you is this chart, courtesy of Bloomberg and the Federal Reserve. Discount window borrowing reaches all-time high. So you can see here, it's gone right through the levels of 2008-9 crisis. It's gone right through the levels of the 2020 crisis. So this is pointing to more trouble ahead, I would say, for the financial sector, for the banking institutions. And that, of course, affects the whole economy, because our economy is not just in the US, but also here in the UK and even in Europe to some extent. They are credit-based economies. So if the institutions that provide the credit are in trouble, our economies will be in trouble. And I think even the IMF mentioned that recently, that we could see trouble ahead. So yeah, the banking troubles we saw about a month ago with Silvergate, SVB, and Signature Bank, and Credit Suisse, they're far from over. That was just the tip of the iceberg, I would say. And the other chart I wanted to show you, and this is from Dr. Paulight, who I've had on the channel several times. The last time I spoke with him, I think, was when I was in Switzerland in January. He posted this on LinkedIn. And he says, in the past, the Fed's emergency loans were followed by strong gold bull markets. So as you can see there, he's using different data. I'm not sure. The data for 2023, as you saw from the Bloomberg article, is much stronger. But maybe that's come off a little bit because this is updated loans March 23rd or 31st of March. Yeah, March 29th, 2023. But as you can see, it's totally outpaced the loans that we saw in March 2020. So am I saying gold is going to go through the roof here? Not necessarily. Things are not guaranteed, but it shows you what happened last time. So let's continue because there's a few more things that I think are important to look at in terms of the banks. The first one is this article here, and this is from a couple of days ago. Big U.S. banks expected to report deposit flight in upcoming earnings. So yes, there have been depositors from smaller and regional banks putting their funds with these too big to fail, the big four. But there's also people taking their deposits out of those banks and putting them into money market funds and mainly into U.S. Treasury securities. And it's ironic because SVB had a lot of Treasury securities and they lost a lot of ground, of course, last year. This year, the Treasury market is still under control for now, but we'll have to see. Maybe before year's end, the FT will be reporting how depositors are taking their funds totally out of the banking system and buying gold and silver, which of course they are. But the FT would probably be the last thing they want to do. But anyway, it says customers pulled almost 100 billion from Big Four, so JP Morgan, Bank of America, Wells Fargo, and Citi, retail lenders in first quarter, according to analysts' forecasts. So this is not good. The other one is more to do with the UK. We're seeing that the governor of the Bank of England wants to increase the amount that is guaranteed by the FSCS, which is the equivalent of the FDIC. Right now, it's 85,000 pounds, which is just over $100,000. So what this shows me is that they're concerned as well about the banking system. He says it's to do more with small lenders, but that's just an excuse, I think, in my opinion. That's my speculation. And what else, just before we go and look at the markets? Well, yesterday we had the Beige Book, which is basically the summary of the previous FOMC meeting. And it shows that the Fed is really committed. It says it's committed to fighting inflation, but when push comes to shove, I think they're going to have to inject more liquidity like they did recently with almost 400 billion added to their balance sheet in 1 week. So it says several Federal Reserve officials considered foregoing rate rise last month. U.S. Central Bank ultimately decided to press ahead with tightening campaign despite banking turmoil. So their meeting was just a few days after SVB collapsed, right? And they bailed out the the wealthy depositors, of course, the Fed and the Treasury, i.e. you, the taxpayer, ultimately because it's inflationary. So there you go. As I said, what we saw a month ago was just the tip of the iceberg. And even with Credit Suisse, I was reading yesterday that the National Parliament, the lower house voted against providing the 100 billion Swiss francs, but it was more it wasn't like it was symbolic vote. It's weird how the Swiss parliament works. There's an agency already that decided to put through that bailout, taxpayer bailout of Credit Suisse. And I remember at the time, there was a press conference and they said, this is not a bailout, it's just a takeover from UBS of Credit Suisse. But now they admitted, the Swiss politicians, that Credit Suisse would have collapsed if they hadn't come and bailed it out. But even though the vote was just symbolic, that's the word I wanted to use. Yeah, the National Assembly, I think it's called, they voted against the 100 billion bailout. But next time, this sets a precedent. So I think it's important to keep that in mind as well. So with that, let's look at the markets. And today we're going to look at the price of crude oil and the strategic petroleum reserves, because I think things could get very interesting. So it's 20 to 9 a.m. London time. We've got spot gold at 2025. It's up $10. Right near the highs. The low's been 13. The key level here is 2032. That's the previous high. Recently, we saw 2032. Was it last week? I think we traded up there. If we break through there, I think we could be up to 2070 very quickly. And why is that? Well, because there would be stops. Trading through 32 would trigger buy stops, and we could see the market trade up very quickly. Spot silver is up 6 cents at 25.55. High's been 58, low is 37. To the stock market, the Dow futures is up 40, Nasdaq 100 futures up 36, S&P is up about 9, just above 4,100. Currencies, we got sterling up 0.1% at 125.00. The euro is trading at 110, up slightly. The dollar is down slightly versus the yen, 133.08. The dollar is unchanged versus the yuan at 687.50, and it's also unchanged versus the ruble at 82. To the other currencies, Aussie dollar is up over 0.5% at 67.27. The Canadian dollar is, or the dollar, sorry, is down 0.25% versus the Canadian dollar at 134.06. And the Kiwi dollar is up 0.33%, 62.30. So to the general commodities, and we're going to start with crude today, because I spoke about the CRB index yesterday, showing that it looks like there's a breakout from a consolidation pattern, and it's the same thing for crude oil. And it's not surprising, because crude oil has a big weighting in that CRB index. So what is a consolidation pattern? Well, it's a consolidation of the previous trend. That's what it means. So this is a monthly chart, and we're looking at this long term, and by long term I mean the next 12 to 18 months. In the short term, of course, the oil price can fluctuate quite a bit. But as you can see from the low in 2020, and I remember that, yeah, crude traded below zero. And why was that? WTI crude? Well, because there's no place to store crude in Cushing, Oklahoma. So people who had bought crude, they were holding that crude and they had nowhere to store it. So it was going to cost them more to find new storage. So they just like gave it away at $37.50. That's why the price was negative. But ever since then, crude has been in the bull market. Yes, we've had a consolidation since the middle of last year, when the Biden administration started selling the strategic petroleum reserves, as you can see here. And he's drained the reserves to 40-year lows, near 40-year lows, from just above 600 million barrels to around 400 million. And they were supposed to have replenished some of it, beginning in January this year, but they decided not to. And I think they've missed the window to do so in a economical fashion. They're going to lose out. But I wouldn't be surprised if they sell even more, which would be very serious because it would leave America with very little reserves of a very strategic asset, of course, which is petroleum or oil. But anyway, back to the chart here. So we've had a consolidation since that top last year, around the middle of the year. Yes, I think we went up to almost 130 back in March. And this is a falling wedge, which means, yes, usually 3 out of 4 times, if we break on the upside of this falling wedge, it means that the previous trend, which was higher from April 2020 to June 2022, is going to continue now for maybe the next 2 years. And I wouldn't be surprised to see crude, well, it would normally should trade above that 130. We could see crude at least at 140, maybe even 200 in the next 2 years. And that's going to create a lot of trouble for the central banks in terms of rising prices, which they call inflation. They'll probably blame it on oil. And as you hopefully know by now, the price of oil is only a reflection of the monetary inflation that we've had, of all the deficit spending. It doesn't really cause inflation, but be as it may, you'll hear a lot of people in the mainstream financial business press saying that oil will have caused all the troubles. But I think the troubles are more monetary and fiscal. But yeah, this is looking very interesting here. I'm not saying it's going to happen overnight. As I said, it's a monthly chart. But we've broken out of that falling wedge. So there you go. I would expect the upward trend now to resume in crude. And it's concerning, I think, for the whole financial system, for the whole economy, for the banking sector. And with that, I'm going to wish you all a very good day. Take care. Bye.